Good day, traders out there. I'm here once again, and I want to welcome you also to the class. Last time we dwell on entry, as we did everything on the chart. So with that, I believe you have learned one or two things about entry, which will actually help you a lot, because most of the times entry is what always cause problem with the traders. So now we are moving on to exit. So what is exit? Exit is a way of getting out of the market, whether you're making money or you are losing money. So the first one we say exit method is a positive exit method. The second one is negative exit method. When I say that, most of you actually know what I mean by that. Positive exit method means where you come out of the market with profits and you are smiling to the bank. Then the negative aspect of it is when you get out of the market with loss. Two exit methods are the two reasons why we always go out of the markets. That the positive exit method is the reason, the reason behind it is to get profits out of the market. So it is one thing to make profit, it's another thing to take profits. Because when you make profit, yes, good, you've made profit, but you didn't take profit because you don't have a take profit level where you actually the maximum amount of money you want to claim as your profit. So if you don't have take profit level, which is positive exit method, there is no way. Most of the time you will always lose, because when the market goes in positive for you, you see your money there in the equity, but the balance remain what it is. So not until you take profit, then the money you have already made will be deposited with your balance, and it will make your balance to increase. But without that, even if you make $1 million above your balance, you only see it in the equity balance, not in your real balance. So if you don't take it, then the market may come back again and you will lose that. You will lose the money you are supposed to have claimed as your profits. So if you don't set your profits, which is your positive exit method, it means that you are not placing demand on the market as to what you want to take out of it when the market is positive for you. Then we are moving to the second one, is negative method. Negative method is usually has to do with stop loss. The reason why they call it stop loss is that so that you can protect the totality of your account balance, your trading account balance. Because if you don't set a limit to the losses you can afford, there's no way you will not lose the whole of your money. Because there are sometimes when you think the market will turn around as it is moving negatively against you, and you thought it will soon turn around, it may interest you to know that that market may not turn around. It will just go. Sometimes market moves for months, and no matter what you have in there, if you don't have stop loss set, let me tell you, you will attract I can't wipe out. I can't wipe, which is a margin call now. So how do we do it now? The simple thing is that always make sure that in every trade you take, always set your TP and your stop loss. That's just as simple as that. Now we are going to go today how we are going to set our TP and our stop loss. So before we do that, let's pick it. The first one is TP. TP now, it depends on you and depends on the market structure. If you know that the market may not move beyond a particular level, maybe you enter from a support area, and you are looking at maybe this price may not go beyond, or may not break through the resistance level, then you can take some few pips below the resistance level as your TP. So that one, it is easily attainable. So depends on you, depends on your risk appetite, and depends on the kind of trader that you are. If you are a day trader, that may be enough for you. if you're a scalper, that may be enough for you. But for people that are swing traders and then positional traders, they always go for very big TP. But then effectively, just make sure that you pick a place where you know that the markets may most likely reach, so that you can take your profits, not just making profits for nothing. Because making profits and then the market comes back again and you only saw it with your eyes, you didn't touch it, you didn't claim it. So the way to claim your profits from the market is to set your TP, or better still, if you don't have TP set up, then you can close it by yourself. When you look at the amount that you have made as profit and you believe that this is enough for you for today, or maybe you have profit targets per day. So when you have read that, why don't you get out of the market? You can also use trading tools to set your target and then leave it. So as long as your metaphor is connected to the internet, whether by VPS, that is virtual private server, or you just on your computer and leave it there, and you are connected to the internet, and by the time they get to your profit target, as you said, the trading tools will cut the whole thing for you and add the profits you have made to your balance. Then let's move to stop loss, because this is the most important thing. Stop loss is the risk that you have taken in the market. So whatever the amount of the currency you are using as your account currency, so the amount that your stop loss is exactly the amount you are staking online as your risk. So if you calculate your pips as for the stop loss, and against the lot size, and you get whatever amount you get, maybe $50, maybe $100, maybe $200, maybe $30, maybe whatever. So that is the amount you are risking, because if the price comes to hit your stop loss and get out of the market, that is the amount you will lose out of your account balance. So that is your risk. That is what you are placed online as a risk. So now let's move forward. Number one, don't ever use the amount you cannot afford to lose as your risk. Don't ever do that. Don't ever do that. If you know that you want a very bigger distance from your entry point, better still reduce your lot size. So when you reduce your lot size, it will give you a lot of space for the market to breathe. So now, where do you place your stop loss, so that at the end of the day, the market, it will be impossible or nearly impossible for the price to reverse back to that point until your TP is being hit. So let's look at it, how and when to. That depends on the situation, depends on the market structure, depends on you as a trader, your experience in the market. So let's pick this one by one. Number one, we are going to look at some people call it signal candle. I also call it rejected candle. So rejected candle is what gives you signal that yes, it is time to prepare to enter the market. So when you see that rejected candle or signal candle, so let's look. Most of the times it always looks like this. In the case of sell trade, so it always look like this. So you know that the next time another candle will form, it may be something like this, and the market is coming down. And then when you enter around this place, let's assume this is your entry point. So when you enter at this place, then that means you can, this is the tip of the candle's wick. So you can, from this place, you can just count like 3, 4 or 5 pips above that level, above this level. So you can place your stop loss here. Believing that it is just impossible for the market to turn them down and come and hit your stop loss. And then just once again, I want to hammer it, any amount you cannot afford to lose, don't use it as a risk, as your stop loss. Take for instance, now in a standard account, we have this one, this 0.01 is 10 cents per pip. It's 10 cents per pip. So if you are trading, let's assume your account balance is $1,000 and you want to trade. Now you sit down and look at it. Okay, if I have like 50 pips as my stop loss, now 50 pips as my stop loss, or let me say 100 pips as my stop loss, 100 pips as my stop loss, and I look at my account balance. I don't want to lose more. I don't want to lose more than $50. So meaning I want to use $50 to trade this, because if it comes to losses, I can't lose more than $50. So that $50 is what I placed online for, that I used to trade. So this $50, now how do I calculate it? Since I know that 0.01 is 10 cents, so automatically 0.1 is $1 per pip. So you look at it. If you know that 50 pips is too small for you, 50 pips is too small for you as stop loss, then you can look at do it this way. If you pick 0.1, which is $1 per pip, that means, and you want to use 50 pips at most, you don't want to risk more than 50 pips out of your $1,000. That means it will only give you allowance of 50 pips. So if you now want to increase it to 100, that means you are going to reduce your loss size. So your loss size now should be 0.05. So that will now be 50 cents per pip. Then that will give allowance of 100 pips. So you can see now that is one thing. So if you calculate this area now, you want to use market structure to set your stop loss. If you calculate it and the thing is more than 100, don't take it. If it is less than 100, if it is like 50 pips or anything less like that, and you look at it and you are sure that it cannot, then that means you can go back to your $1 per pip, making like, so giving you, but you are sure that where you place your stop loss, the market cannot easily turn back and hit that place, at least for a long time, until your TP has been hit. So then you can use this one as your stop loss. You can use this one also, this kind of calculation, basing everything on what you can afford to lose. That if the market should go the other way around against you, then you can lose more than that $50. So per trade, we are talking about per trade, but if you want to minimize your risk and you want to diversify your portfolio, maybe you are taking like 2 or 3 trades at a time, which is not actually advisable. I will tell you what to do. You can do that, but there is a way you do it. There's a way you do it. We will talk about that maybe in this lesson or maybe in the next video. But if you have enough time, because this video I don't want it to be too long for us. So now the other one is to consider the support and resistance level. Let's assume that you have a breakout here. This is your resistance, this is your support, and then the signal you received is buy signal, because the market had already broken out of this, and then you enter around this place. Don't forget about the entry we talked about, that when the markets break out, come back for a retest here, and then move upward. So we are talking about that one. Go and watch the video so that you can know how to enter correctly, whether it is returning back or it is just moving on like that. You will not lose, you have nothing to lose. So let's continue now. So now this is your resistance. Then if you enter this place now and you calculate the distance between your stop loss and your resistance level, and it is not more than what you can afford to lose, then no problem, just place your stop loss around this place, that is a few pips below your support area. So your stop loss will be here, your entry point will be here, and then you can pick your TP according to your discretion, whether by the market structure, whether by what you can have, what you think is going to be easily attainable for you, and which is okay by you, at least for that trade or for that day. So now this one also will actually give you a safer place to place your stop loss. Then you can use moving average methods also, just like maybe you have like you have 2 or 3 EMA, let's say EMA 1, EMA 2, EMA 3, and then so when we have the market just move and move and move like this. So as the price is moving, and let's assume you have a buy signal here, and then the market, this is where we have a retracement, went back here, resume. So immediately it resumes, you enter around this place. So this place now become your entry point. You now look at it, so you can just place your line here, and then you can use, depends on the lot size you are using, and then depends on the structure of the market at the time. So if this place will not between, that is a few pips behind this one, it may be a few pips behind this one, it may be a few pips behind it, depends on your risk appetite and the lot size you are using and the market structure. So if you calculate the whole thing, and this place, the third MA, if from your entry here down to this place as your stop loss, if it is still within what you can afford to lose, then you can place it there. If it is this place, you can place it there. If it is this place, you can place it there. Depends on you and what's the amount you can lose. But always keep it in mind that whatever is going to be your stop loss, that is your risk, let it be within the perimeter of what you can let go for the market, so that it will allow you to be able to trade the next time in order to recoup your loss. So because if you lose all of your money is what is representing you in the market. So once you have no money in the market, you have no hope of making money out of the market, because unfortunately for so many people that are gamblers, the forex trading is one of the businesses that you cannot make nothing out of something. Before you can make money out of forex trading, you have to invest money. You have to fund your account in order to make money out of it. Otherwise, if you are trading demo, you can make $1 million. It is nothing because it's virtual money. So it has no value at all. So once you lose your money, then you have to go and look for another money to fund your account again, to start again. But it is not good when you can protect the one you have there. So always make sure that what you are going to lose is not, in fact, I don't always go out, because of my experience, going calculating all this and that. All my own is that, okay, I have $1,000 in my account, I don't want to lose more than 20 or 50 pips. That's why I just calculate it by the market structure, the area where I thought the market, and then I make sure that alongside with my lot size. So now I will want to, we are going to, by next video, we are going to talk about more about the how to maximize your TP, I mean your profits, how to maximize it. So we are going to talk about that one. Maybe, but I pray that the Lord will give us strength and the grace to do that. So now this is how you try as much as possible to make sure that you have. So when that, you don't lose hope. When you lose, let me tell you one secret. Trading system has 3 phases. If those who are listening to me now, if you're a professional trader, you have been trading for a very long time and you have experience in the market, you will bear me witness. Number 1 is profit phase. Number 2, break even. Number 3, losses phase. When you are able to discern that yes, it is time for my, it is profit phase for my trading system. I tell you, the trading system, even if you enter carelessly, your trading system will still make money for you. That is the profit phase. It will still make money for you, and then you see that you are placing trade like 5, 10, and almost all of it are just getting it right for you. That means it is in the profit phase. But when it is the time for break even, you see that your market will just move a little bit, come back, not really giving you what you want as profit, and it's not even, sometimes market, you may enter the market right now thinking that before the evening everything will be okay. You got there, you see that the market is still, consolidating, moving like snails, moving in and out of your above and below your entry point. It's just romancing with your entry point, and at the end of the day you decide that okay, let me just get out of the market with just little profits. And sometimes if it is automated trading system, it will just finish the whole thing at just a break even and all that. That means you will not be making money for some times, because when the market structure, the way it's moving is that when it's actually moved for a setup, when it is moving for a setup, there's no amount of trade you can make. It will either give you loss or break even. But when the setup is fully developed and mature, then you will see that for sometimes it will be making money for you. So at the end of the day, it will now, when we are having something like retracement or consolidation or whatever, the market will come back. That time it may enter into loss phase. But if you have the experience, you will discern that time and know that this time around it's like how to stay up the market for some time, so that when these loss phases will be out. Or you can use the minimum lot size just to be testing the market to know when it will go back to its profit phase. So it has 3 phases: profit phase, break even phase, and losses phase. So when it is on losses phase, you will see streaks of losses. You may trade like 5 times and lose the whole 5 times, or even like 4, and the 51 will be break even. That means your trading system is at losses phases. So you have to make sure that you discern that. When you discern it, so meaning that there are times you stay after the market, there are times you test the market to see maybe it is coming back to its profit phases. So you test the market with very small. You don't test you don't just put in all your egg into a trade just because you want to make big amount of money. No, if you take forex trading as a business, as you can take it serious as your business, you will handle it as a business, because every business comes with risk. So now depends on your risk appetite. Some people are risk aversive. Most of them, you hardly find them in the area of businesses. They don't take risk at all. Some people don't like taking risk. Some people, they like taking little risk. They say, okay, let's just do it little by little, gradually, and all that. So some people, they are gambler when it comes to taking risk. They don't care. Their own is take all, lose all, which is not a good thing for a businessman if you want to survive the market. So now you have seen all of these things. So I believe the little one you have learned today, you'll be able to apply it to your trading career, and it will help you to increase your your profits, and then to minimize your losses, because when you cannot see a trading system that is 100% perfect, there is no holy grail. You see once you see the trading system that is giving you like 60%, 70% profit rate, then just with that particular trading system, hold it and study it more, so that you can always improve and increase your income through it. Even if you calculate the RRR, which is risk reward ratio, if it is ratio 1 to 2, I'm telling you, with 50-50 with 50-50 risk 50% profit rate, with 60%, 70%, you have a very good system. Even if it is 50% profit rate, and you are having if it is 50% with ratio 1 to 2, it's a very good system. If it is 60-70 with risk rate reward of 1 to 1, at least it will be a game of number. You trade 10 times and you lost 3 times, you made money 7 times, so you have to remove your 3 out of this. So 3 out of this, now the remaining 4, so your 4 is going to be your profits. So that is risk reward ratio 1 to 1, meaning that if your TP is 50, then your stop loss also is 50. So you should know that it's going to be a game of number. So your TP must be more than this one before you can make profits. But at the same time, if your trading system is giving you 60%, 70%, 80% profit rate with risk reward ratio 1 to 1, is a very good system. So with ratio 1 to 2, if it's giving you like 50%, even 40%, we make money with risk reward ratio 1 to 2. So that is it for today. We'll come back again by God's grace. So now, if you have any comments, not negative one, not the one that shows pride, but please be moderate in your comment. You want to commend us, you want to encourage us, or you want to correct us in one way or the other, you want to whatever that is good to hear and that is good to encourage people, not only me but those who are watching this thing, also a trader like you, or you have comments to add to more what we are teaching now according to your experience in the market, just to help us, just to encourage us, just to help us to improve and to increase our knowledge, please do in the comment section. No problem. If you have not subscribed to this channel, please do so. Subscribe, like, share, click the notification button, so that anytime we post new videos, you will be among the first to know. And then you come here and see what we are doing. God bless you. So till another time, my name is Olufemi Adeyemo of Open Gate Forex Academy. So next time we see. Bye bye.